We look at crypto as as a pointer to excess money. We had so much excess money. In fact, if you looked at the growth of M2 money supply in 2020 as a result of the massive stimulus that has already been given, never mind the stimulus we're talking about, and yet that didn't make its way into inflation. CPI actually fell over that same period. All of that excess money, instead of going into wages and goods and services pricing, actually ended up going into the stock market. We saw an expansion of the stock market, but it went into other assets as well. And Bitcoin is a perfect symptom of this excess money. If you just look at cryptocurrency and its meteoric rise, look at special purpose acquisition companies, SPACs, you look at the double B tranche of the CLO market. I mean, we're talking about the riskiest sectors of the market basically attracted excess capital. And Bitcoin, because its rise was meteoric, it is also super sensitive to any concern that we may see a contraction in that excess money.
Bitcoin had an $8,000 round trip, Gina, yesterday from the highs to the lows and back up near the highs. I mean, simply, I don't know if it's incredible or insane, but it's nothing I have seen in 25 years of doing this. NASDAQ, technology, the rotation out of growth names. We're starting to see that value stocks are only about a quarter of the economy, growth the other 3/4 here. Where are you seeing value right now?
So it's a real challenge because we saw actually the growth actually reasserted itself after about 3 months of a value rally at the end of the year last year. And January seemed to be a return to growth. But right now we're looking at a situation where you have you commented on so many elements of a post-pandemic boom. We see so many pieces of evidence that a post-pandemic boom is on the way. And so you see the yield curve steepening and concerns that suddenly the equity risk premium isn't going to stack up very well. But the reality to that concern is that even though we may see a rise in bond yields, and we already are seeing it, the front of the yield curve, because of the way that the Fed actually designed their framework, is going to stay low for at least 12 months, because in order to move short-term interest rates, you have to see 12 months of inflation.
Shepard Smith here. Thanks for watching CNBC on YouTube.